Hi everybody. I'd like to welcome everybody to our next installments of what I'm going to call the Taxman's Tidbits. A little bit of fun tax information, hopefully to get everybody to pick up on issues as they come up in the real estate space and be able to avoid pitfalls. Today's topic is going to be welcome tax. Welcome tax is a concept we all know. In fact, it's not the real name of it. It's actually called the Quebec Land Transfer Tax. I'm sure many of you know, but if you don't, welcome tax is actually an anglicism of the minister in 1992, who was the Minister of Municipal Affairs, Jean Bienvenu, who introduced this tax into our lovely province. Bienvenue being in French, translated as welcome in English. So let's talk a little bit about this tax and what we need to know. In terms of the amount of tax, well, first of all, the City of Montreal has an incremental tax that is far in excess of the amount across the province. In Montreal, on the first, let's just say $517,000, you pay about 2%. You pay less than 2%, you pay 0.5% on the first $57,000, and then of course above $2 million, you pay 3%. This is in contrast to the rest of the province of Quebec, where the rate, it's a plafond, it hits the ceiling at 1.5% on anything over $258,000. So know right off the bat that when you purchase a home in Montreal, the land transfer tax, the welcome tax, is going to be higher. Just for comparison's sake, it might be fun, I just looked around the country to see what the different rates are, to see how we place. Well, in Ontario, you're at 2% over $2 million and 2.5% in the city of Toronto. In British Columbia, you can go as far as 5% on properties over $3 million. They have a lot of influx of foreign investors, and it was a quick way for them to get some money. And in a place like Alberta, you don't pay any tax. Alberta seems to be one of these places where I think we should all consider moving one of these days. Very low or non-existent income tax, no transfer tax, basically a place where they want entrepreneurs to come in, they want to bring in people, and they're willing to reduce the tax base to do it. I'm a big believer of that. All right, so let's talk a little bit about how do you calculate the welcome tax. And again, I say this because when you buy real estate, when I buy real estate, I always do all kinds of cost analysis calculations to determine if what I'm buying is a good deal. So the welcome tax is a cost of acquisition, and you should be factoring the welcome tax in to your rate of return on the property. So just for your knowledge, when you're buying a new property and there is GST and QST, the welcome tax does not factor in the GST and QST. It is before that. So that's good to know. At least we don't pay tax on tax. Secondly, how do you calculate the welcome tax? Based on what? Well, if you're buying a new property, it's usually the higher of one of these three. Either the builder's sale price in terms of new properties, or it's the price shown on the deed of sale. And before you think that you could just lowball that and just have a low value to say welcome tax, be very careful, because as I mentioned in one of the previous sessions, if you're buying something from a related party or you're selling to a related party, you got to be very careful, because there's a deemed disposition at fair market value, so you can't manipulate that. And the third thing is the municipal evaluation. So they're going to hit you on the higher of the three. So unfortunately, there's no real way to get around it, and it's something that you've sort of got to deal with. All right, let's talk about exemptions to welcome tax, because not all transactions will generate it. So first of all, this is one of the tax planning that we do quite often, depending on the needs of the client, is transfers between spouses, common law and or married spouses, do not generate welcome tax. So at times, whether it's for creditor proofing purposes or for other tax planning purposes, we might decide to move a property between spouses, and it's nice to know that you don't get hit with the tax a second time. Another thing is ascendant or descendant direct lineages. So for example, grandparents, children, any movement of property between them does not generate a welcome tax. Note that in the city of Montreal, there's always a $200 administrative fee, so you do have to pay that, but that's nothing significant. So oftentimes, if we're doing planning, we don't need to worry about being hit a second time. And then the other thing is, when we do tax transfers from an individual to a corporation, there's a possibility to exempt the welcome tax, but there you've got to be careful, because you have to have 90% of the voting shares owned by the same person. There's planning we do that to get around that when we can, in situations where we're going to issue multiple shares, but that's a little bit beyond the scope of this little information session. But just know that when you transfer a property from an individual to a corporation, a new corporation, in what we call a tax rollover, you will not have to pay the welcome tax. But you've got to make sure that when you do that, that the notary has special wording in the deed of sale, so that the city of Montreal will understand that this is a situation and doesn't send you the bill, and then you've got to call them up and fight it and go through the whole story. The City of Montreal also requires that that voting share of 90% stays there for at least, the 24 previous months. So it's part of the planning. And again, as I always say, let's not get caught up in the details. The purpose of these sessions is to make you aware of issues, not to turn you all into tax professionals. So spouses, ascendants, descendants, and transfers to corporations in which you control 90% of the voting shares do not generate welcome tax. That's a good reflex to have. Let's talk about splits or divorces. And this is really important because I can't tell you how many times I've been involved where the person came to me too late and I couldn't do something, and it was a shame because now the taxes will apply. So in the case of common law spouses, so two people who are not legally married, if a transfer of property occurs, it has to occur within 12 months of the separation. And the separation has a legal definition in the civil code, and the separation is really when they separate, when they're no longer living together. Usually within 12 months, all of the details have been worked out, and the spouses have actually transferred the properties. But if they haven't, you got to be careful, and sometimes it's one of those things that you need to be aware of. So if you have a situation where a house is being sold and people are separating, and that's why they're selling, and you're a real estate agent, it's one of those reflexes I want you to have to just tell them, listen, make sure you get it done within that 12 months. In the case of married couples, it happens even more often that it has to be within 30 days of the divorce. And oftentimes people have a good situation where they may, figure something out later on, and later on do a transfer after the 30 days, but unfortunately then they're going to get caught with the welcome tax. Basically, there used to be a way to get around the welcome tax when individuals owned significant real estate within a corporation. And I'm sure real estate agents will be aware of this, and commercial real estate agents probably have seen this before. So I have a corporation. The corporation buys real estate. And now if I sell the real estate directly to a third party, there's going to be a welcome tax. And it could be significant. I mean, I've gone in deals where the welcome tax is in the hundreds of thousands of dollars, which is a big transaction. So what used to happen then is that rather than sell the asset, they would sell the shares of the corporation. And by doing that, it wasn't a direct transfer of ownership, of title, and therefore they could save the welcome tax. This used to be a huge tax saving situation. And I still have people call me today that ask about this. Unfortunately, in 2016, in March, they introduced new legislation that basically prohibited this. So even if you sell the shares of the corporation, you're not getting out of the welcome tax. Also know that there's special rules dealing with welcome tax in the event of death, in the event of estates. It's really a little too complicated for me to go into in such a short information video, but again, the purpose of these videos is not to turn you into tax specialists, but rather to give you that checklist of, oh, there was a death, there's a transfer of property, there's something there, need to reach out to a tax professional. Same thing when you have partnerships. Partnerships, you didn't used to be able to transfer properties to a partnership or from a partnership without having a welcome tax issue. And in 2010, there was a landmark case, La Ferme CGR, and basically now it is permitted, but under certain guidelines. So you've got to always remember that whenever you're dealing in a situation that's out of the norm, the reflex is there's probably a tax angle, whether it's income tax, capital gain tax, welcome tax, and your job is just to be aware of it and to reach out to somebody who can really break it down and try to figure it out for you. In December 2017, there was also new rules for transfers of partnerships. So partnerships, and again, I don't want to get too much into it because it can get complicated, but with a corporation, it's the voting shares that we're looking at. So if you own 90% of the voting shares, and we could structure a corporation, different shares, different individuals, and preserve that 90% for purposes of avoiding welcome tax. But with a partnership, the rule goes beyond that. It actually goes to the share of the partnership, not necessarily the votes. And where that's important is when you have partnerships with limited and general partners. And again, what's the difference? A limited partner has limited risk. A general partner has unlimited risk. Because the 90% rule applies towards all risk and rewards, you have to be careful because you may be hit with welcome tax. It's called, it's a 90% test and so forth. So in essence, that's it for today. Just be aware the exemptions are there in situations where spouses are transferring, children, parents, grandparents are transferring, or to and from, two corporations by individuals. Partnerships can kind of go both ways. There are ways to exclude welcome tax. And Montreal has a special tax compared to the rest of the province. So if you want to avoid the welcome tax, maybe look outside of the city of Montreal to different cities. I'm wishing everybody a great day, and I'll see you next week. Bye-bye.